President Trump is poised to unveil a new wave of tariffs as part of his America First economic agenda, branding the event as Liberation Day. This move reflects his commitment to revitalizing the U.S. economy by prioritizing domestic production and job creation. While the specifics of the tariff plan remain under wraps, the White House has been signaling confidence in the strategy, pointing to preliminary indicators that it's already bearing fruit. According to administration officials, there has been a surge in private investment, amounting to billions of dollars flowing back into the United States, suggesting that the policy is successfully encouraging businesses to return production to American soil. Despite some jitters on Wall Street, the administration is reassuring both the public and investors that these tariffs are designed to boost domestic manufacturing, increase job opportunities, and enhance tax revenues. The president remains optimistic that the long-term benefits will outweigh the short-term market fluctuations, predicting that Wall Street will eventually stabilize and thrive under the new economic strategy. Economic analysts are closely watching for details, as the announcement could have significant implications for global trade dynamics, particularly in sectors that rely on imports. Supporters of the tariffs argue that they will correct long-standing trade imbalances and protect American industries from unfair foreign competition. However, critics warn of potential retaliation from trading partners, which could disrupt established supply chains and lead to increased prices for consumers. As the nation awaits the full outline of the plan, the anticipation is palpable, with debates intensifying over whether the strategy will truly deliver the promised economic resurgence or lead to unintended consequences. The administration remains resolute, emphasizing that the tariffs are a calculated move to secure economic independence and long-term prosperity for American workers. In the coming days, the focus will shift to how industries and international allies respond to this bold economic stance, and whether the anticipated surge in domestic production will offset potential trade tensions.
They will be effective immediately, and the president has been teasing this for quite some time. They're not going to be wrong. It is going to work, and the president has a brilliant team of advisors who have been studying these issues for decades, and we are focused on restoring the golden age of America and making America a manufacturing superpower.
There are numerous uncertainties surrounding the White House's approach to the proposed tariffs, as officials have yet to specify how they plan to implement them. White House trade advisor Peter Navarro recently stated on Fox News Sunday that the tariffs could potentially raise $600 billion annually, a figure that some interpreted as indicating an average tariff rate of 20%. Reports suggest that President Trump has been considering a flat 20% tariff as a means of generating additional revenue to help balance the tax cuts he aims to pass through Congress. However, this proposal has sparked significant debate among economists and policymakers. Moody's chief economist warned that a universal 20% tariff, particularly if met with full retaliatory measures from other countries against U.S. goods, would be a worst-case scenario. According to Moody's simulations, such a tariff structure could result in the loss of approximately 5.5 million jobs, increase the unemployment rate to 7%, and decrease GDP by 1.7%. The potential economic fallout has raised concerns about the broader impact on the U.S. economy, particularly in sectors heavily reliant on global trade. Despite these dire projections, the president's supporters remain optimistic, arguing that the administration is unlikely to pursue such an extreme tariff measure. They believe that the final policy will be more balanced and strategic, designed to protect American industries while minimizing potential economic backlash. Nonetheless, the debate continues as experts and policymakers assess the potential consequences of various tariff strategies, with some urging caution to avoid triggering a global trade war that could undermine economic stability both domestically and internationally. As discussions progress, the focus remains on finding a solution that bolsters American economic interests without risking significant job losses or provoking harsh countermeasures from trading partners.
You have to trust the president's instincts on the economy, okay? And why? This isn't blind faith. Remember what he accomplished in the first administration.
Everybody's a little concerned. We all are. But at the end of the day, we got to have faith in our leadership. Our country's going in the wrong direction, $37 trillion in debt. We've got to get manufacturing back to the country, people back to work. A better way to do that is tariffs. So Let's give it a shot and see what happens.
The ongoing debate surrounding President Trump's proposed tariff policies has raised numerous questions and uncertainties. The president recently stated that he might not fully equalize tariff rates with certain countries due to the significantly high rates some of them currently impose, admitting that charging them the same rate might be embarrassing. In addition, there are indications of a potential new charge for other countries and sector-specific tariffs. For instance, steel and aluminum imports are already subject to a 25% tariff, and starting tomorrow, a 25% tariff will also be applied to auto imports, including auto parts. While some countries, like the UK, are actively seeking agreements to offset these measures, such as negotiations focusing on artificial intelligence, other nations are reacting differently. Recently, the Prime Ministers of Canada and Mexico discussed strategies to strengthen their trade relationship and mitigate the impact of U.S. tariffs. In the business community and on Wall Street, reactions are mixed. Some still hold hope that the White House might reconsider the tariffs if they negatively impact the economy, while others remain cautious. For example, Goldman Sachs has predicted that the proposed tariffs could lead to a 35% chance of a recession, with Canada facing a particularly tough road to recovery if a recession materializes. Moody's analysis suggests that an escalation of the trade war could result in the loss of approximately 5.5 million jobs, pushing unemployment to 7% and reducing GDP by 1.7%. However, the administration has demonstrated flexibility in the past, delaying tariff implementations when faced with backlash from affected companies or when other countries show a willingness to negotiate. Supporters of the tariff strategy argue that it is a necessary step to bring manufacturing jobs back to the United States, promoting economic independence and reducing reliance on foreign goods. They see the move as part of a broader strategy to balance trade deficits and strengthen domestic industries. The administration's allies believe that imposing reciprocal tariffs is essential to ensuring fair trade practices and preventing other countries from exploiting the U.S. economy. Despite the potential challenges, proponents maintain that the ultimate goal is to create a more self-reliant and robust manufacturing sector, even if it means enduring short-term economic disruptions. Nevertheless, the implementation of such tariffs is a complex and unprecedented economic experiment. Wall Street remains apprehensive, as the longevity and stability of these tariffs are uncertain. Businesses are left wondering how long these policies will last and how they will impact their long-term planning. Building new manufacturing facilities domestically takes time and investment, adding to the skepticism regarding the feasibility of swiftly revitalizing the U.S. manufacturing sector. The administration's stance is clear. Reciprocal tariffs will remain in place as long as other countries impose tariffs on U.S. goods. While the vision of revitalizing American manufacturing is ambitious and appealing to some, the economic and geopolitical ramifications are yet to be fully understood. As the situation evolves, the global economic landscape could shift, testing the resilience of both domestic and international markets.